Here's the market question. Elyse, are you more bullish now than you were yesterday morning after what you heard from Powell?
Sure. We were having a lot of conversations about this on our floor yesterday. I think what we learned from the Fed is that we have to start entertaining our bull case a little bit more. But we came into yesterday's decision on the front foot, and we've been, encouraging investors to add back to risk exposure. We have a relatively bullish view on the S&P 500 for the year ahead, and I think this just kind of underwrites our conviction in that call.
What's the bull case?
Bull case is S&P 500 ends next year above 5,000, but we'll see. I think that would probably dictate the Fed cutting before the second half of the year, but right now our base case pencils in cuts in the second half of the year, not yet the first.
So the banner's Ausenbaugh says Fortress Diamond calls 5,000 SPX. Okay.
Year end. No, not quite. But I would say, isn't there a risk we could be there in January based on what we're seeing play out at the moment?
That was exactly
I think January feels a little aggressive. We still have to see, the earnings come through. We are making this call that the earnings recession is likely over and that we're going to see rolling earnings recoveries. But let's get through the fourth quarter reporting season and then look beyond to 2024 results.
That sounds like equal weight and not market cap weighted S&P. Is that right?
We do have conviction in making sure that you have exposure to the other 493 names in the index beyond the Magnificent Seven, but we're constructive on the Magnificent Seven. I mean, these companies are projected to grow earnings north of 20% in 2024, and that is definitely an exposure that we're encouraging investors to hold.
What's your conviction when everybody gets out of cash? What's going to happen? We've never been here. $6 trillion in cash. We get under 5% money market fund. What happens?
Well, I think you have to take into consideration that bonds are back on the table, right? That, to me, means that there is still a trade to step into some duration and not necessarily just plow into the equity market. I think some folks will remain a little reticent given where valuations are today, but given the improved free cash flow generation of S&P 500 companies relative to 10 years ago, we are comfortable with today's valuations. We just don't think that that's going to be what drives the upside into the next 12 months.
Elyse, it's good to see you in person. Thanks for coming in.